Okay, so really briefly here, we're going to be looking at Learning Objective 3, which introduces you to GAAP, Generally Accepted Accounting Principles. This is something that's really important that you need to know. Um, but these are the sets of rules and practices that we follow, right? Why are we following it? Because we are doing financial reporting. Your income statement is a financial report. Your balance sheet is a financial report. And so there are rules that are set up that you have to follow to do the reporting, which is why you learned earlier in the chapter that the balance sheet is actually classified and that you have to put the accounts in a certain order on the balance sheet. Why? Those are the rules. That's part of GAAP. Okay. And so that's important to know. The important thing too is to understand how GAAP is actually created. How do we get all these rules and practices in place in the first place? Well, basically, it's all done by CPAs, by the accountants that do financial reporting, which are certified public accountants. They have a very powerful board called the Financial Accounting Standards Board that debates and sets up all of these types of rules for financial reporting. And so accountants themselves are the biggest contributors to GAAP being what it is. However, because most of the financial reports that are done publicly are through public corporations, and the government um, oversees the markets, including the financial reporting on the markets. So the Securities and Exchange Commission also joins in with the accountants to have a say in how GAAP should be, because it is about financial reports, and those reports have to be standard for everybody. So that's basically how all those rules get set. The one thing that's important to know, though, is that GAAP is basically a US thing. It's basically a USA thing. The rest of the world, for the most part, uses standards called IFRS, the International Financial Reporting Standards. We do not. There's some things that GAAP and IFRS have in common, and there's some things that they don't have in common. And so if you are a US company, you have to report using the standards called GAAP. If you are a US company, means you're based in the US, you're headquartered here. But if you are headquartered in another country, then very likely you're using the IFRS standards to do your financial reporting. And just like the financial accountants are involved in putting together the rules that we call GAAP, there's an international accounting standard boards that basically is in charge of putting together the rules that are for IFRS. And that is how it's all set up. But you do have to know what GAAP is. All right, that's really, really important. So quickly, you got to understand too about how accountants determine a lot of this stuff. And so you're going to be introduced to a few things. First, information needs to be useful, and accounting information needs to be useful. And how they determine what usefulness is based on two fundamental qualities. One is the information has to be relevant, and information is relevant when it pertains in making a difference in a business decision. That if you knew this information, it would affect how you make the decision. So relevance is very, very important. The other part that's really important is it has to be accurate. Faithful representation means you have to have a complete record. It has to be free from error, right? It can't be biased information. It has to be as is. So those are fundamental qualities of all accounting information, and that's important to sort of understand how it's done. Then you have what we call enhancing qualities that are listed here. So all companies, regardless what industry they're in the United States, if they're public companies, they're using these same accounting principles. So comparability means that it doesn't matter where we're talking about Tesla, or we're talking about, how McDonald's did, two very different industries. When you're looking at their financial statements, they are comparable. You can read them equally. They're using the same standards. The information on all those accounting statements can be verified. Okay, so it's a verifiable process. Who verifies it? Usually someone called an independent observer. We call those auditors. So these are outside accounting professionals that come in and look at the books and say, yep, they're following the rules. Okay, that's basically how things are verified throughout the system. Of course, everything needs to be presented in a specific fashion called, that's what understandability is. That's why you have to learn about the classified balance sheet, right? Because it has to be presented in a specific fashion. They've already figured out how to present it. You're just learning how to do it. For understandability, all businesses use the same fashion. Businesses have to use the same accounting principles year to year to year. So all the records are consistent and make sense. And of course, the information is reported in a timely basis. For the most part, what we get is monthly reports, quarterly reports, and annual reports. But either way, things have to be quite timely. All right. A couple of assumptions here that are also part of the financial reports that are part of GAAP is one, all the companies are using US dollars when they're reporting on their income statements and balance sheets. So, for example, you have Coca-Cola. Actually, you have a lot of companies that are global. I'll just pick on Coke. Um, Coca-Cola is the largest soft drink company in the world, not just in the United States, but in the world. And so, yes, it's easy to count money in the United States because we all pay and they sell in US dollars. But when they're selling Coke in Mexico and they're collecting pesos, they have to go ahead and report that in US dollars because they are a US based company and their financial reports are going to be based on GAAP, US standards. Okay. So even if they're selling Coke in Russia for rubles, they have to go ahead and convert that to US dollars for financial reporting purposes. Economic entity assumption basically is we have to keep things separately. Records have to be kept separate. So this usually happens too for smaller companies that, if you start a business yourself, you need to keep separate records from your personal stuff. So you shouldn't be, mixing your business numbers in with your personal numbers. They have to be kept somewhat separate to see that there's two separate entities. And that's part of what that assumption is about here. Two other assumptions that you're going to hear about. One, you're going to see really in the next couple of chapters, something called the periodicity assumption. And that means that all businesses have their life broken into artificial time periods. These time periods are not so artificial that you don't know what they mean. They're very clear. Monthly time periods, quarterly time periods. A quarter is a 3-month period of time, and an annual time period, which is a 12-month period of time. So all businesses basically are dividing their reporting into that structure: months, quarters, and years. No more than that. No shorter than a month, no longer than a year. And this idea of a company being a going concern means that we are going to look at all these corporations as lasting indefinitely, right? So, Henry Ford started Ford Motor Company. I mean, he's been dead for years. He's pushing up daisies. Um, but Ford Motor Company is surviving. Why? Because of going concern assumption. Walt Disney would be stunned at his company at this point in time based on when he died, or is he really dead? He could be frozen, whatever. I don't know how they're going to defrost him. Let's put him in a microwave for 10 minutes. But nonetheless, Disney is still around. It's the future is unlimited, going concern. Okay, assumption. And then GAAP, generally accepted accounting principles, actually has some principles that you're going to be seeing come to light in this book. One is that when you look at the assets on that balance sheet, they're actually listed at their cost, what it actually costs the company to buy it, not what they're worth today. So that means if you look at General Motors and they bought, buildings in downtown Detroit for $1 million, but today their market value might be $100 million. What you're going to see on the balance sheet is what they actually paid for it. That's the historical cost. It'll be down as $1 million on the balance sheet. Balance sheets also have to make sure that when they do list the asset and liabilities on their statements, that they're not overstating anything. So that's really the fair value principle, that we have to make sure we're never overstating the value of any of our assets or liabilities. We also have to make sure that when we are putting together our statements, we are disclosing all the circumstances and events that might affect our financial future, because the users of those statements want to know, you know, and so that's part of full disclosure. We also have to make sure that anything we do disclose is true and accurate and not premature. Right. And so providing information that is prematurely provided might mean that costs and benefits are not equal. Right. So should we actually disclose the fact that we're losing a lawsuit? Yes, we're disclosing that we are being sued. We shouldn't be disclosing that we've lost a lawsuit, because A, we haven't lost it yet. That's number one. It's premature to say. B, even if we did lose it, it's not over, because we can have an option to appeal. So we don't really disclose until everything is done, because then we would be following sort of a cost constraint. Because if we did say we were losing this, that information might really hurt the company, when in reality it's not happening yet. And that's how learning objective 3 ends, basically. There's a whole bunch of concepts and principles that you just learned about, and basically you're going to be defining them. And that is learning objective 3.